Student here at business school. This is Sean. He was a broker for 13 years. Today he does different things, but he really knows his stuff, and we're glad that he could come on today. One of the coolest dudes you've met. So we're going to talk about investing today, just the basic principles of investing, stocks, bonds. Those are the main two that we're going to cover. We're going to briefly touch on ETFs and mutual funds. Does anybody invest right now? Really? How do you invest? I'm just curious. Sorry,
you mean like Roth IRA?
Like, do you use Roth, or do you like manage your own investments? Do you
So I have both Roth and just like normal with Robert the app.
Okay, all right. So you trade on Robinhood. Do you like it?
It's free, so
Yeah, it's free.
it's
Yeah,
nice to play around with.
yeah, it's kind of cool. Yeah. So we're going to touch on those different aspects. Sean's going to go into what his stuff too. And why should you invest right now? This is something that you guys have probably already heard. So the main reason why you probably should invest right now when you're young is to start compounding everything for retirement, because we picture like long run stuff. We're not talking about like day trading or anything like that, just long-term investments. So if you're age 20 right now, so let's say you're 20 years old, you want to retire at 67, and you have $100 saved right now for retirement, and you want to invest $100 every month into like a Roth IRA, then you're compounding it at 4%. You guys know how much you'll have at retirement, 67? No? Any guesses? Nobody?
$2 million.
$2 million. Thank you, Jay. All right. I can't remember what it was. I think, 2.3 million. So, and that's a good amount of change. So that's why you should start now and start compounding. So, and by the way, I want this to be like kind of an interactive presentation. So if you guys have any questions, something doesn't make sense as we're going on with this, just pop it up, ask us. And so without further ado, Sean.
Oh, all right.
Yeah, you're already up, man.
Okay.
All right. Oh, there's a graph to show you guys what that would look like compounding.
2.25.
2.2. No, 2.3. Oh, nice. Yeah. All right.
Okay, I'm gonna move this out a little bit,
Cool.
and if you have questions as we go along, we'll just hit it. I think it's on. It's green.
Yeah, we're recording.
We're good?
Yeah.
All right, listen, I'm gonna be fast because we don't have that much time, and we're gonna cover a lot of bases. And then if you want to stop me because you don't get something, no problem, and I'll just try to cover it. I'll give you a lot of information, and hopefully some of the seeds will get into that mind of yours and be able to help you. So, personal factors prior to investing. You want to make sure that you have some money that is going to care for all the needs that you have, and so you'll never have to touch the money you're investing. You never want to touch the money that you're investing. So you don't want to get all excited and go and get a brokerage account and buy some stocks that someone tells you to do, when next week you're going to learn that the kid you're supporting in Sri Lanka needs $500, and then you go and sell that stock to help them. You need to have a cushion relative to your needs. So usually the rule of thumb is you should have about 6 months savings of what your job pays you and what all your expenses are, and you should have a great cushion in a bank, in a typical savings account or a money market in a brokerage firm, and you just have that money there, and you use that for your emergencies, and you never touch the money you decide to put into any sort of investment. Today's world really has a lot of a trading mentality. It means I'll buy today, I'll sell tomorrow. And I would just suggest to you that we don't see any traders on the Fortune 500 list. So they're not making the real money in this. Some people hit it big. Don't play the trading game. Buy long. That means invest in something and hold on to it and let it work for you. Now, that's at one side of the spectrum. That's the conservative side. The other side is, you might be somebody who you want to get started in investing, and you say, I'm not going to wait till I have 6 months savings, and I'm just going to get into it. And if the kid in Sri Lanka needs money, too bad. I'm not going to give it to him. So you might be the super high risk type of investor, And if that's the case, you can do it. The only thing I would add to this, prior to that, is make sure you have your consumer credit eliminated. What that means is, if you have a credit card that you're paying 17% on, it doesn't make any sense for you to put money into the stock market that will give you a 12% annualized return. None at all. You should pay off all your credit card debt, unless you're smart enough to leverage your money, and that's a separate subject. We're talking about the basics of what I would tell my own children. So get rid of consumer credit debt, work on that first, save enough money for the rainy days and the problems, and then now we're going to enter into how to look at investment. So why invest? And I'm going to just talk about one main thing. Why invest? One word. Just write this down. Inflation. That is just one word to consider. What that means is, let's say that you have $1,000. And for instance, the Vietnamese culture, when they came over, when North Korea and South Korea and all that fell, and they came over in boats, those people did not trust banks. So they would take their money and they would put it under their mattresses and consider themselves safe. So let's say you have $1,000 under your mattress. You have your savings, you have your consumer credit gone, and you put that $1,000 under your savings. Well, right now, inflation is about 3%. So what that means is, 1 year from now, this $1,000 will buy 3% less in terms of durable or consumable goods than it did the year before. If you keep that $1,000 under your mattress for 10 years, how much is it? If we annualize 3% inflation, it's a 30% loss. So when you go to spend your money 10 years later, if we annualize 3% inflation, and all that means is the cost of goods going up every year, 3%, you'll have a 30% loss in your $1,000. That means you'll really only have $700 of the $1,000 that's under your bed in buying power. You understand? Buying power is what that money you have will buy for you in that day and age. So just inflation alone. You want to be able to invest to get something better than 3%. All right? So if you say, okay, I've got my savings set aside, I've got rid of my consumer credit, I want to invest now, there's essentially 3 ways to do it. And hopefully I'm not going to step on Larry's toes here. You can invest your money in cash, you can put your money in loans, and you can put your money in things you own. Those are the 3 ways. Cash means you go to the bank, you open a savings account, they say we'll pay you 2% on your money, it doesn't even keep up with inflation, and there you go, all right? Cash instruments. And there's some other cash instruments, I won't go into it. The loans that you can invest in means you are taking your $1,000 that's under your mattress and you are making a loan to some institution in this world. All right? There's generally 3 ways that where you can loan that money. Anyone know what they are? First way?
Bonds.
Okay, bonds is what we're going to talk about in my realm entirely, simply because I'm not going to talk about real estate or REITs or anything like that. So let's just talk about, so synonymous with a loan when it comes to investing is bonds. Okay? What kind of bonds do you issue? What kind of places issue bonds?
Treasury.
Okay, so you have the U.S. government issues bonds, and then what's another type of place?
Corporations.
Corporations issue bonds. And then you have another type.
Municipal.
Municipalities, very good. Those are cities or counties. Okay? So what happens is you will take your $1,000, you'll look online, if you're doing it yourself, you'll go to a broker, and you'll say, I want the safest way to invest, that would be U.S. government bonds. I want the second most secure, which are municipalities. Those are cities that are issuing bonds. The city of Salt Lake City is issuing a bond to build a bridge over the Great Salt Lake. All right? And so you're trusting that the city will pay you back your money that you've loaned it. Okay? And then the third, usually the least secure, but also secure, are corporations. Shell, the McDonald's, whoever. They're going to issue bonds, all right? Now let's just stay on bonds for 1 second. I'm going to teach you something that most people don't know about bonds. Have you ever heard, if you watched a financial report, someone say something to the effect of, bonds have gone up, bonds have gone down, right? Okay, this is all relative to the interest rate. So let me explain. You take your $1,000 out from under your bed and you say, I've decided I'm going to loan that money to Apple because I trust Apple in their credit rating. And so I give Apple my $1,000 and I buy one bond. This is just called par value. This is the value of the bond, okay? And to make it easy, you loan Apple $1,000 and Apple says, you can see it in the bond, that they will pay you 5% interest. That means annually, every year on the bond, and at maturity, which let's say is 2030, they will promise to give you your $1,000 back. That's how it works. There's a maturity date, there's an interest rate, there's a credit rating, and there's a company. Any questions so far? Okay. You lock that in. You make an agreement. Apple says, we'll pay you. You say, here's my $1,000. And then every year you plan on getting 5%. What's 5% of 1,000? $50 a year. You plan on getting an interest. Well, guess what? Inflation's 3%, so you're really going to make $20 net profit truly on the 1,000 from investing the $1,000 with Apple. All right. Here's the deal. You lock that in when you buy the bond. It doesn't change. You are guaranteed the 5% till 2030. But right now in the general world of the U.S. Economy, let's say interest rates are hovering at around, well, let's just say 5% for argument's sake. Let's say in 2025, interest rates shoot up to 8%. And that means if you wanted to buy a bond in 2025, you could get 8% instead of the 5 you're locked into. What happens is, on paper, the value of your bond goes down. And you'll get your statement and it will show your bond's value at $800. You'll scream, I've lost money. You haven't lost money unless you sell the bond. If you hold it to maturity, you will get your $1,000 back. But if you need to liquidate, which is why we don't talk about liquidation here, early and do it before maturity, you're going to get what the going rate is for your bond, which is predicated on interest rates. So if interest rates go up, the price of bonds that have been purchased before go down. If interest rates go down, guess what happens? So you're locked into 5%, and let's say in the general economy, interest rates drop to 3%. Somebody says, wow, Larry here, he has a 5% bond that's going to pay all the way till 2030, $50 a year. I'll pay him $1,200 for his bond. And so you can see your statement, and you've made money on the bond. And then what people do is they say, well, I'm going to trade bonds. Okay? They say, I'm going to invest in bonds, and when interest rates go down, I'm not going to sell because the value of my bonds have gone down. And if they say interest rates have gone down and I'm locked into something higher, and they sell their bond portfolio. Now, we're not talking about $1,000 here. We're talking about a $100 million portfolio of bonds. So if a broker has $100 million of somebody's money in Apple at 5% till 2030, and interest rates drop to 3%, he's going to take that $100 million portfolio and he's going to sell it because he's made a ton of capital appreciation on the bond. Okay? Really quickly, the 3 types of bonds are treasuries, like I said, or like he said, government bonds. Where did that go? Government, munis, and corporate. They all have ratings. They all have agency backed. You have to, that's a whole separate subject. We could go for a couple hours on bonds alone. But just let me tell you this. Muni bonds, municipal bonds, like the City of Salt Lake City issues, all the interest on those is tax-free, federal taxes. So the rich, the wealthy, the Kennedy family, for instance, live off muni bond portfolios. All of their money has been, at least it was years ago, set in portfolios of municipal bonds that are always paying tax-free interest to them, federal taxes. And so the rich get richer because the treasuries, government, and corporate bonds, usually their interest is taxable. So that's if you decide with your extra money to loan it to somebody, all right? Any questions on bonds in general before we go to stocks? Yes?
Do you usually recommend doing that trading if the value of your bond goes up? Do you usually recommend that?
I would, but it's predicated on some things. Here's what. Right now, interest rates have been low forever. So you get offered Apple bonds at 3.5% till 2050, way out there. Well, I would say never do that. Why? Because there's only one direction for interest rates to go in our world today, up. And your portfolio is going to go down when they go up. So what I would say is go short term. Don't buy any long term today. Wait until interest rates get in the double digits if they ever do, and then lock in the long terms if you can find them. That's how you capitalize on the money the best. Excellent. No other questions? Yes.
The percentage that you're paid yearly.
Yeah.
Are you allowed to spend that money? Or
Yeah.
Okay. So they like give it to you. You can use it.
They send it to you, yeah, if it's in a non tax deferred account.
Okay.
So if it's but if it's in a tax deferred account, the money will accumulate under the umbrella of the Roth or the IRA or the 401k or whatever it is.
Okay.
Yeah.
So the actual coupon rate's never going to change. It's just the market value of that, whatever that bond is set, that will fluctuate.
Every day.
Every day.
Until when?
Until it wants to do.
Until maturity. Right. Perfect.
Yeah.
So what happens is old people, they want secure income. Their broker tells them, let's put you in some treasuries, let's put you in US government bonds, whatever. They get their statement, they say, we gave you $100,000, we locked in 4%, and our $100,000 is only worth 98 today. What have you done to us? All they're seeing is just the fluctuation due to interest rates. If they decided to sell that day, yes, they would be ticked. But if they hold to maturity, remember that line, hold to maturity, they're gonna be fine. All right? Larry, will you do me a favor?
Absolutely.
Will you erase this while I talk about the other things? Okay. So cash, banks, you get that. Money markets, which are brokerage firms, they're liquid. So there's a liquidity risk with bonds, meaning you put your money in them, they're not necessarily perfectly liquid, meaning you don't get the full value of your money out instantly. So there's a liquidity factor there. There's also risk factor with bonds. Is it a junk bond? Is the corporation behind it Freddy's Barbecue down on 3rd? Or is it, Apple or whoever, some company you adore? There's credit risk that you got to consider. There's political risk you have to consider today. If there's a takeover of a company in Bhopal where all their money is centered, so you have to look at those risks too. All right, owning. So we've talked about owning, and another word for owning when it comes to investments that brokers do, not real estate, what's another word for it? Anyone? Starts with an E. Equities. Okay, another word for stocks is equities. Okay? Those of you who own real estate know that if you bought a house for $100,000 and now it's worth $120,000, you have $20,000 worth of equity, to make it really simple, right? Equities means ownership. Equities in the investment market are equivalent, generally speaking, to stocks. Why? Let's say that McDonald's stock is going for $40 a share, okay? And you buy one share. And you go into McDonald's and there's a plant in the corner that is worth about 40 bucks. In theory, not in practicality, you own that plant. You own a piece of McDonald's. You owe $40 worth of McDonald's. Now, of course, you don't get to appropriate how that's spent, but that's what an equity means, ownership in the company. So you want to look at companies that you have researched. You want to look at companies that you trust. You want to look at companies and what they offer in your mind that are viable to this world now and in the future. And what you're saying when you buy that stock is, I like owning a piece of XYZ stock, okay? So far with equities, just let me explain this. When a company goes public, that means they take their company and this is the company, and they offer it to the public. What happens is there's a whole bunch that goes on, but essentially they offer, let's just say 1 million shares at an IPO price, that's the initial public offering of X dollars. Let's just say $5, okay? At the initial public offering, when the company goes public, these 1 million shares will be offered up to this classroom. You guys represent the world. And you have heard from people that this company, which is known as the Zebra Company, is really good. I mean, it's worth it. So you take your $1,000 and you say, I want in on this IPO, and you take your, and so you get 200 shares of the IPO at $5. And that is called the initial public offering. After that time, and the company, the Zebra Company, gets a great portion of the money that you spend for their shares just in the IPO. After that's done, once it's done, everything is traded now publicly. And what that means is you will get now for your shares what the public will pay for it. You will not, your $5 means nothing. Nothing. That's just what you got when you initially bought it. Now, if it shoots up, you're really stoked, right? I paid $5, it's gone to 20 on the IPO. Man, I've really banked. But if it goes down, you're really bummed. Most IPOs have a very difficult time, right? So I'm just telling you how it all starts. So now, once the Zebra Company is publicly traded, every day the amount of buys versus the sells dictate the price that Zebra will be. If there's a ton of buyers, Zebra keeps going up. If there's a ton of sellers, Zebra keeps going down. That's all there is to it. And so what you do when you want to buy equities is you want to buy a company that meets all the criteria that suit and help you feel relatively secure in what their future is, unless you're a risk taker. Okay, so I just want to talk quickly about some of the things that you can do. Am I over it? Am I over the head? Are we understanding? Is it too much? You can tell me. I slow it down. We can talk about. All right.
So
Yeah.
just for a company standpoint, for a bond, that's like a loan that they're taking out. And then for a stock standpoint, when the company issues stocks, that's like a free, I don't want to say free loan, but they don't have to owe any of that money back. So that's why stock trading is appealing to the company. However, they allow a ton of ownership into the company, which that's a downside of the company going, on a company standpoint, of why going public, why they would probably resent going public.
And typically, if the company goes defaults, the common shareholder gets screwed.
Mm-hmm.
So just to let you know, yes.
What does that ownership look like in practice?
That's a great question. Meaning, if I was able to get in on the IPO and own 501,000 shares, I could take over the company. But they have all kinds of safeguards in there with the brokers and the issuers and the underwriters and the company to make sure that they're protected from that. But that's what an aggressive takeover is when another company starts buying up the shares to get a majority of them, they own the company then.
So if you have, let's say, a third of their shares, what does that look like?
Voting rights.
Voting rights?
Yeah.
Okay.
It translates into voting rights. Great question, though. Okay, so what you were saying, Larry, so the bondholders are typically, if I'm not mistaken, this is how it used to be, are paid off first. And the common stock shareholders, if there's anything left of the company, are paid off last. Okay, so here are some ways that you can look at stocks. And these are the ways you can break them down into two groups, fundamentals and technicalities, okay? And most stock buyers, they look at one or the other for some reason. They don't care to, one camp doesn't care as much about the other. So the fundamentals, what does the company do? Who is the management? What's their education level? What was the underwriting? How many shares did they offer? What's their past business look like? Where are they located? All the risks that come in with that. What are the external factors that can harm them? Interest rates, taxes. Do they have a good CEO who she or he is smart and they know what they're doing with the company? Those are just the fundamentals. So if you're buying a company that is selling tiny plastic hamburgers, you know, as a little novelty toy versus semiconductors, the product matters, and you guys know this, so that's pretty simple. The technicals are, have you ever opened up the financials and you see charts? Technicians are known as chartists, and they're the guys and girls who go in, Larry, and erase, and they chart things about the stock. And there are people, very analytical people, who absolutely live and die by the technicals of a stock. What's happening with its price earnings ratio? And there's almost a technical chart for almost everything a company could possibly be involved in. So there's volume technicals. What's the volume of the stock? The volume has been super high in trading. They look at that one way. Or what is the advanced decline theory? How many times is it advanced versus how many times is it declined, the stock price in a given month? These are technicals. You open up your Wall Street Journal. You don't do open up anymore. You look into your Wall Street Journal, and there it is, right? All right. Here's what typically happens. Remember, this is called the odd lot theory. I love this because it's humorous. And it's in the papers. It's in the financials. How does the odd lot theory work? Well, XYZ company is trading at $1 a share. And you know, it has great fundamentals and great technicals. And so the analysts and the CEO and the CFO and these people who are Wall Street traders, they get in and they buy. Now, when these guys buy, they buy what are called round lots. What does that mean? They buy 100 shares. They buy 1,000 shares. They buy 100,000 shares. They buy round lots, okay? So XYZ goes in a month and it goes to $2, it's doubled. Man, now we have the managers of companies, and we have, you know, some people who are interested in the market, who watch the trends, and we have other market makers.
I'm not endorsing you trade. I'm just letting you guys know this is what I personally use, and Sean uses stuff. Yeah, so Sean uses it. Doesn't mean it's the best thing in the world. Doesn't mean it's worse. It's just that's what we use. Sean actually got me hooked up on E-Trade, so cheap. It's cheap. Yeah, it's cheap. Cheap trading and everything. So this is a Roth IRA. So we're going to talk about retirement accounts in just a second, but this is what the interface, the dashboard kind of looks like. So you have your net assets, your day gains, net value days, and it's just pretty much what's in your portfolio. You can see your contributions right there. But if you actually wanted to buy a stock, so you go up here to the symbol and then put in the ticker. So like Apple, for example, AAPL is what its ticker trade is. And then you can see all the fundamental stuff, all the numbers and the graph and everything. And then you can see buy and sell. If you wanted to buy it, or if you wanted to sell it, if you already own some, you buy it. You just put it in the order. Apple, buy quantity 4 shares. Price type. Sean, can you help me with this one? Right here. So with the price type, you have market and you have market on close. So you can choose to buy it on market.
Yeah. So
right instant when you place that order. Market on close is whatever the closing price is. The rest of it. Oh, Sean,
well, I'm just going to cover the limit because stop on quote is sort of like a limit, and stop limit on quote I think is beyond what you want. But really quickly, a limit just says I'm willing to pay $5 for this stock and no more. When the stock is climbing, and you have to put it outside the price. So if the stock's trading at $4.75 and you're willing, you want it, but you do not want it if it's more than $5. You don't want to buy it for $5.25. You set a limit price on it, and they will, if you're in line with the trades, you'll strike at that and you won't pay any more. But the way it works is you can miss out on a limit order in a market day. So you just you're setting limit orders because you just don't want to put in a market order in and buy the stock at $3 more than what you intended, and that can't happen with a market order.
Yeah. Okay, cool. Does that make sense to everybody? All right. So once you actually own the stock, this is kind of what it looks like in your portfolio. You see the ticker symbol. You can trade it right there. You can see the day changes, the day gains, your total gain, and then your percentage total gain. And that's pretty much, and then you can see the value. You can't see it right there, but you can see the value of what the share is at that time. And you also see the price you paid for it. Yeah, so that's the same price paid. So you can see all that stuff. Does that make sense? Everybody? Any questions? No? Okay. All right, so retirement accounts. So we've talked about investing, what to put your money into. We recommend retirement accounts. These are the different ones that you can do. 401ks usually through a company, somebody that you work for, 403b, etc. We want to focus on Roth IRAs primarily because they're taxed before you put your money in. So you put your money in, it's taxed, it grows, and then when you take it out, you don't have to pay any taxes on that money. And then traditional IRA, it's the reverse of it. So you put your money in, and whenever you take it out, when you're 59 and a half or whatever it is, then you're taxed on it. So that's why Roth IRA tends to be better. Anything you want to add on that? Or?
Yeah, the only thing I would add is that on your IRS tax returns, it will ask you, have you contributed to an IRA? And that's a traditional IRA it's talking about. They might even ask about a Roth, but traditional IRA means you put money in before you were taxed on that money. Therefore, you can write it off, the amount you put in on your taxes for that year. That's the benefit of the traditional IRA. The Roth, there's no write-off, but the benefit is after the growth, you get to take the whole sum out after you're 50, 65, 59,
right here.
without any penalty.
There it is. So they actually just bumped the contribution. So there's a limit contribution you can do a year. It used to be $5,500, now it's $6,000.
Oh.
So yeah. So sweet grows tax-free. So withdrawals at 59 and a half. There's a couple exceptions to that. One is like if it's paying off student loans, and another one is if it's buying a house. You can take, I believe it's up to $10,000 you can take out if you have that much in there. And then so how to open up a retirement account? There's a couple different ways to do it. You can go through your bank. If you have Wells Fargo or something, just call somebody, say, hey, I want to open up a Roth IRA or an investment account, and then they can get you somebody to talk to. There's investment banks, so like Vanguard or Merrill Lynch. If you guys have a 401k, most likely you have them through Vanguard's managing it or Merrill Lynch. It depends what bank you have. If you have Bank of America, it's Merrill Lynch. Wells Fargo, I have no idea. Or you can do a financial service company, which is what E-Trade does. So that is where you can manage everything in your portfolio. So you can say, okay, I want to buy a bond, I want to buy an ETF mutual fund stock, and you go on your service, and then you just buy it right there. So yes.
What about credit unions? Will that be under banks?
Yeah. So, and then to figure out, yeah, what's up?
I was just curious, are retirement accounts like this Roth IRA, are these bonds, or how does that money get used? Where does that go?
So, you want me to? So a retirement account is just the account that money. It's like, think of it as like a savings account, but it's instead of a savings account, it's a Roth IRA account.
So if you open it through Vanguard, it's basically letting Vanguard use your money for that time until you do. Okay, so it's like through the institution that you can open it up.
Yeah.
Okay.
Yeah. So, and when you put that money in, then they allocate it wherever they I mean, I think you can actually like buy stuff if you wanted to, but it's very limited. Like there's a Vanguard 2060 retirement mutual fund thing. So,
Which is why I would recommend if you're going to use a retirement account, you go with E-Trade because they don't have an annual fee versus most banks and financial institutions will hit you with a $35 to $55 fee, even if you only have $2,000 in there. So do it yourself, and then it's called self-directed IRA, where you choose what you want in that through the vast amount of investment vehicles that are offered through E-Trade.
Yeah, and then that kind of goes into here. If you're going to go with an advisor, find somebody that really wants to help you. Try to find somebody that has integrity. Don't do it. Okay, and understand what you're getting yourself into. Understand the fee structure. So like what Sean was just talking about for advisors and for financial companies. So like for E-Trade, it's like $6.95 per trade, but that's like for like 1,000 shares or 1 share. So it makes more sense to buy more at one end. And then some accounts make you have a minimum in there. E-Trade doesn't. Yeah, it doesn't because I didn't have a minimum. And then some of them do like $500 minimum, $1,000 minimum, and then user interface, whatever you prefer. Some of them are better than others. So
if you buy 100 shares through E-Trade, it costs you $6.95 for the shares to buy. It costs you $6.95 to sell. If you did it through Morgan Stanley or a major wirehouse, it'll cost you $35 to $48 to buy and $35 to $48 to sell. So if you're going to trade at all, which you probably shouldn't do, go with self-directed through E-Trade.
Yeah, and then so this is just to put things into perspective here with fees. So the black line, this is investing $1,000 a year with brokerage fees, and you can see that it compounds. So like if you guys have a brokerage account through somebody like that manages at Merrill Lynch, you might see a fee and it'll say like 0.03% or whatever, something really small. Well, over the time, those fees compound. Whereas if you were doing it just yourself, just putting your money, you have an E-Trade account, you're just throwing money in there, that's how much more you're gonna have. So 1.3 versus 3.7 million in growth. So it kind of puts things into perspective a little bit. So, but no, you're not. All right. Do you want to add anything?
Yeah, one last thing. This will be quick. Just talk about diversification, and that is where instead of just taking your money and putting it in, like let's just say you have $100,000. You guys will have that someday if you don't have it now, and you put it in, lock it in at 8%. Let's say they're bonds for 20 years. At the end of that, you'll have $684,000 from the original $100,000. The rule of 72 is you multiply 10 into 72. You interest rate into 72, and that tells you how long it takes to double your money. Okay? Here's the thing about diversification. You take the same 100 grand, you put 20,000 of it into a stock, another 20,000 into an aggressive stock, another 20,000 into a mutual fund, another 20,000 into bonds, another 20,000 into an aggressive mutual fund. The first one you lose, 0. It goes defunct. The second one you get 0% return in the 20 years. The third one you get an average annualized return of 5%. The next one average annualized on 10, and the next one average annualized on 20. The difference between the 20-year income result is, I believe, I know it's 980 something, 984,000, let's just say. So you're talking about a 33% difference just by diversification, realizing that the first two are doing nothing for you. You lost the first 20. So I really would suggest if you're young, be more aggressive, be smart, don't be stupid, and do your research and then buy and hold.
And also, like, start off with a couple hundred that you're willing to lose, just to get the feel for it. You know what I mean? And then, so that's pretty much the presentation. So this, I put up these up here. These are some good resources that I've personally read and interacted with. Bill Town, he's a hedge fund manager. He writes really good stuff. He makes it really simplistic to understand. The Intelligent Investor was the book that Warren Buffett actually read before he started getting into investments. And then Ben Graham, the author of it, was kind of his mentor in trading. Invested is a podcast. It's kind of cool just to hear him talk about what's happening today. And then I put Dave Ramsey up there, not because he's an investment dude, but because he'll tell you something different than what this guy's telling you and what Ben Graham tells you. But mainly because what Sean touched about in the beginning was having your finances in order. So, getting on a budget, paying off high credit cards, and all your debt and stuff if you can before you start putting a lot of money into invest. So, that's it. You guys have any questions? Did we go?
Good job, Larry.
So, is there any gray area that you guys have that you guys are thinking yeah, what's up?
I just had a really specific question. Can you does E-Trade offer Roth IRAs?
Yeah.
They offer. And they're not the only ones. You can go with any brokerage.
Yeah,
Or
my wife does
firm or
this on with Vanguard.
Yeah.
and stuff.
Yeah, so,
She has a question, Larry.
yeah. Hey.
Which one is better, Merrill Lynch or Fidelity for the retirees?
Which one's better?
Yes.
I don't know.
Merrill Lynch is a full-service brokerage. Merrill Lynch is gonna charge you for everything that you buy and sell at a fairly high rate. Fidelity is like a middle ground brokerage. They'll charge you a little bit less, but you're limited to what you can buy with Fidelity, typically. Merrill Lynch, you can invest in anything, you'll just pay a higher amount of a fee.
Can I ask which one do you recommend?
Is it for a 401k or a Roth or IRA?
Roth.
For Roth?
Yes.
I would recommend E-Trade.
E-Trade?
Yes, definitely. It's called a self-directed, and you will have to learn how to do it. But you can get recommendations from them and research from them. It's all right there, but you're going to be looking at and deciding what you want to do with your money. It's very easy. You look at mutual funds, they'll tell you what's in them, how they're managed, the fees, and you can do it, and you'll save yourself a ton of money.
Thank you.
And I would give you one hot stock tip, Canadian pot stocks. They're awesome. I'm telling you, look at Aurora right now. Aurora's good right now. And I'll give you a bunch more, but that is going to go. Already has.
Yeah.
Thank you so much.
All right, any other? Yeah, what's up?
What about investing for dividends? What are
So-
your opinions
I honestly don't care much about the dividend because what the dividend, so if the company holds, they don't pay out a dividend, it could mean they're reinvesting that cash into R&D or whatever into the company to help it grow, which will ultimately hopefully help the stock grow. So I don't focus on dividends, but if they pay out, then awesome. Does that help, Sean? Do you have any thoughts on dividends?
Just the difference is dividend-paying stocks typically are more stable, they're more blue chip, they've been around a long time. They're paying out because they don't need to do more R&D, they don't need to do any of that. And so for grandma and stuff who want a higher return on their money instead of a bank, that pays them out a higher % dividend. It's good to have them in something like that because utility stocks pay higher dividends, they're secure, they're stable. They go up and down a little, but they're really good for giving people who need a little bit more bang for their buck. For a guy your age, go with non-dividend producing stocks that are gonna put all their money into what Larry was talking about.
And also, if you're in a stock that's paying out dividends, and that company's been paying dividends for like 30 years, let's say, and they stop, typically a red flag on the company. So, just, watch out for that. Jim.
I was just gonna mention, want to thank you all for coming today, and if you have surveys right in front of you, if you don't mind filling them out just to provide any feedback for our office. There's any other questions for Larry?
I just feel I really like your life and things you can go get like personalized help with like figuring out what a good plan for your situation is.
So it's like, any firm that does trade, they'll love to talk to you.
Okay.
So even E-Trade, if you call them, they'll help you out.
Okay.
Yeah, E-Trade or Vanguard or Wells Fargo, they want you to go with them, so yeah, they'll help you out. They'll give you their advice probably and what they recommend and all that stuff. Yeah. Any other questions? Oh yeah.
So you mentioned that mutual fund is like a portfolio of stocks that the market.
Yeah, so I mean they can contain anything. So they can be a mix of stocks and bonds, even real estate, or they can be all stocks. And they're labeled differently. So and you can see what they have in them. Or if you can't find everything, you can see the top stocks or whatever that makes up that mutual fund.
If I like the returns on a mutual fund, would it be better if I shadow it rather than buy it as ETF?
Shadow the mutual fund rather than buying the ETF.
Like follow this portfolio rather than buying the actual fund itself.
I mean, you could. The thing is though, there's so much stuff and they buy so much of it that it's kind of hard. It's like you're the little guy. So you know what I mean? So that's the thing. And I mean, it's kind of interesting too because you have somebody managing that, and because there's so much cash into those stocks and whatever into it, when they start pulling out, it causes the price to go down. It's kind of like what we talked about the theory or whatever when you know, you have the little guys buying at this price, I mean, the big guys buying at the small price, and then you have everybody kind of stacking up on it, so. Yeah, but as far as mutual funds, I mean, I think they're pretty safe. I shouldn't say that, because you guys might hold me to that, but I mean, they're safer than buying individual stocks. But if you want higher returns, then go with more individual stocks, but do your homework and see what fits with your vote and everything, so. All right, any other questions? I'm sure you guys can ask Sean too, after you guys.
They were ready to run.
Yeah, all right. Cool, thank you guys for coming, grab cookies and stuff.